Good evening and welcome to the weekend edition. My name is Peter Resnicek. Big question that we are going to answer in today's program is, should traders and investors buy NVDA? This is on the minds of a lot of people, I imagine, right now, especially because the stock is about to have a 10-for-1 split on June 10th. As far as the broad market is concerned, we also have a lot to talk about. If you recall from last week's show, we talked about the historical significance of the bearish engulfment pattern. And in this particular week of trade, we did actually get that move lower. So when we get into the charts, we're going to see exactly just how bearish this move was, and more importantly, where the next action points for traders are. All right, without further ado, let's get into the charts. Plenty to talk about on the smaller time frames, of course, but it is May 31st. And what does that mean? We've got monthly charts that are closing. So we've got to kick this technical portion of the program off, find out what's really going on the longer time frames first. So I'm kicking it off with an S&P monthly. And the main takeaway here is, if you just look closely at the bars in terms of what happened in the month of May, even though we did get the pullback that I was expecting this week, where did we finish out the month? You got to say, not bearish at all. Now, granted, because these are monthly bars, anything can happen in the month of June. It is relatively common that you can have a bullish bar like we saw 2 months ago and it gets retraced. Just remember that. But however, if you're just looking at this on a strictly technical basis, reading the tea leaves, or I should say reading the candlesticks, so to speak, pretty bullish monthly bar in the S&P for the month of May. A little bit more granular now, moving over to the S&P Daily so we can get a feel for exactly what was happening over the course of the week. Again, this was the bearish engulfment bar we talked about in last week's episode. Remember that I called it the reference bar, and I said that there was potential for accelerated selling below the low of that bar. You can see that it actually played out very, very close to how it was historically in the last few examples that I showed you, where you had a couple of days of up, followed by down, and then the low of the reference bar was taken out when we went lower. The only problem with this scenario is, how far did we go? It was very tricky, kind of, because we went about a day and a half. You can see we went down Thursday, and then Friday we went down quite a bit as well. But in going down, we did not test the uptrend line. There's an uptrend line in effect in the S&P coming from back here about March or April, and we did not test it. So that's a piece of market generated information to carry forward in your narrative. That being said, what I think is most important here about this chart that you should take away, there's a number of factors, but we'll just break it down piece by piece. Firstly, as the market moved down, you did get a rollover of the 8-period moving average. However, not anywhere near the 21. You have the 21 riding underneath, which is that green line. We didn't get near it. Simple, keep it simple, TA. All you need to know is, did you get a pinch or did you not get a pinch? Obviously, a pinch is when you have the faster moving average kind of crossing through like that, through the slower one. We didn't get that at all. One of the things that I look for in my own trading, and when I'm looking to figure out what bias is or how the market is changing direction, is very simply that if a market moves down and the faster moving average, in this case being the 8 EMA, comes down close to the 21 but does not pinch, sort of maybe comes down, kisses it, comes down near it, turns back up, that tells me a lot about the nature of the downtrend. Obviously, in this case, the 8 never really even came close enough to the 21 for that to be in play, but it's something to think about. Now, that being said, look at what happened on Friday. The reversal was just ridiculously strong, especially late in the day. But most importantly, where did it take us to? Right back down to the downtrend, right? This is where the show gets a little bit more actionable, which is really what I want for everybody. I want everybody to take away from this show what the action points are, how we should be comporting ourselves going forward, what the trade is going to be. So for me, this basically changes the tone almost back to bullish, because as you can see, one of the first things I do is, once a downtrend starts, I have to define the downtrend. And again, keeping it simple, how do you define a downtrend? Very simply by connecting highs. So you can see right here, we've started to connect the highs and forming a downtrend. So what do we do in terms of actionable information? We sell calls above the downtrend. Whatever the market is holding below that downtrend, we try to find charts that are maybe rolling over a little bit more bearish. I like to find stocks that are actually holding up quite well, actually, because those calls are going to be more rich. My basic MO is that if a stock or a market is up, I want to be net short calls because they're very rich in terms of credit collection. If the market is down, I want to be net short puts. I want to be using that increase in implied volatility, also increase in the values of calls on the way up, increase in puts on the way down. In this particular market now, we've actually rallied back to the trend line, and you could almost make the argument that it's almost broken. This market may not even be in a downtrend anymore, and that downtrend was very, very short-lived. So if we come into next week, all you really want to be looking for, very simply, is are you going to get a close of a daily bar above this line? Once a daily bar closes above that line in the S&P, understand that it becomes very, very much more difficult to retest this low at all. It just becomes a bit harder, and that's when you start shifting back into the sell puts, buy calls MO, as opposed to as soon as we started rolling over here, as far as I was concerned, for the weekly options room that I run, we immediately switched to a sell call buy put, more of an MO, and that served us very well in this last week as we started to roll over. However, relatively short-lived, as you can see, market kind of turned around. And in and of itself, I think that's a lot of market-generated information, right? Think of how where the market has been as of late, been very, very overbought. I think sellers were really ready for it, ready to take the market a bit lower. But again, you want to just use those signposts on the chart, keep it simple, 8 EMA, 21 EMA, uptrend line, downtrend line. How far did it go? Not very. Did we get to the uptrend line? No. More importantly, when we breached the 21, right, and breached the 8, did we have a confirmed close on the daily below either of those levels? Well, the answer is we did, but only for one day, right? We have the Thursday bar right here that actually closed below both of the key moving averages, below the 8 and below the 21. Friday moved definitively below the 21, but where was the close? Way above the 21, okay? So that's pretty much the situation going forward. Again, I know I keep saying this phrase over and over, but it's really important. Keep it simple. That's why I only like to use 2 moving averages, both exponential and the trend lines on the chart. You notice no RSI, no CCI, none of these indicators. All of that is just lagging price, etc., and it's really just restating price in another way, and I feel that there's just no place for that in your TA. You want to keep your TA as simple as possible, let the trend lines define what you're doing, and then overlay those 2, they're not simple, they're exponential, but those 2 short-term moving averages of 8 and 21 on it. If you just stick with that, I think you'll be fine direction-wise. But anyway, for next week, looks like the downtrend might be over. I'm looking for a daily bar to move above. And if so, then there's no reason why the high here isn't in play. But more importantly, and again, from an actionable point of view, telling you how you could be playing this, how I'm going to be playing this, when you are dealing with weekly options, remember, you don't need to be that precise. What you really need to have success week in and week out and be consistent is simply to be on the right side of things. You have to know, when do I shift into selling calls, buying puts, and when do I shift into buying calls and selling puts? And as I was saying, we were quite successful this week, right when the rollover started happening, flipping over to the more bearish side. Now I'm relatively flat, and now I'm going to see what happens as that line comes into play. If it crosses, what will happen very simply, I just shift gears in the other direction. That's the beauty of being a short-term retail trader. Larger institutions can't really do this. They're not that nimble. They can't move that quickly. But we as smaller retail traders can certainly do that. We can change our bias by the day, by the hour, certainly by the week, and we can act accordingly. Now let's get a little bit more granular. Hopefully this will help you to discern intraday direction a little bit better in your own trading. If you'll notice, when I started with these charts here on the big screen, I started on the monthly and I went down to the daily, and now I'm going to go down another couple levels, and I'm going to show you this 5-minute chart on the ES. This is the E-mini futures of the S&P 5-minute. This is showing just today, mostly the late day action, as you can see. But what I want to point out to you specifically is this purple line here. I've simplified the chart, and I'm just showing you just the volume weighted average price. And there's a number of reasons why I want to go over this right now, because it's actually going to set up what we're going to talk about in our next segment when we talk specifically just about NVIDIA. But without going into a long primer and discussion and education on what the VWAP is, just understand that there is a volume weighted average price every single day in securities and in futures. And these VWAPs, as they call them, can be used 2 ways: for day trading or for longer term trading. For longer term trading, usually what you do is you use something called an anchored VWAP, where you pick a day on a daily chart and you find, for instance, a swing low or an IPO event or an earnings event, and you find a specific starting point on the chart and you calculate what is the anchored VWAP from that point. It tells you exactly what the volume weighted average price is from that moment. On a shorter time frame such as this, you can use it very, very effectively in the futures market to try to figure out whether or not you are above VWAP or below VWAP and what the type of bias should be for that day. These volume weighted average prices are actually very, very responsive to tests intraday, especially in the futures. I do it a special way where I take this VWAP rather, not anchored VWAP, and I started at midnight each day. Usually if you're trading stocks, that volume weighted average price will start calculating from 9:30 a.m. at the market's open. Obviously, because the futures trade close to 24 hours, you have to pick a point where that VWAP is going to start. Most people start it late in the afternoon, like 5 or 6 p.m. when the new futures session actually begins. But I have found in my own experience that it's much more accurate to actually start the VWAP at 1 minute past midnight every day. So that being said, what I wanted to point out to you, just in the interest that maybe this could be of help to you because the move up was so violent on Friday, and maybe you could have seen that or profited from it, or at the very least covered shorts, etc., not gotten hurt. When the market was coming down on Friday, right, if you recall earlier today, the initial move was strong to the downside in a continuation of selling, but then it reversed around midday, and that happened right around here, putting in a low of about 52.05 in the ES. But here's what I want to draw your attention to is after that, it's very, very normal for a market that is far extended to the downside. Obviously, the volume weighted average price slowly catches up to it, right? Makes sense, just like a fast moving average, it slowly catches up. And usually if you rally from the lows and you hit that moving average, let's say you're using an 8 on the 5 minute or a 21 or even different time frames, you very often get rejection off those levels. And if you don't get rejection off those levels, that tells you that the buying might be a little bit more than short covering, a little bit stronger than you thought, and maybe you need to flip your bias. So the same exact thing happened on Friday, which I hope if you take this to heart and use it in your own trading, it could be of help to you, is the fact that when we rallied a bit off the lows, notice what happened here. We came close to the VWAP, kind of backed off a little, went to the side, and then we touched the VWAP. And this is where things get really interesting, is that around 2 p.m. Eastern on Friday, the market actually touched the VWAP. And as I was saying, this is almost always a short point, right? Especially if the market is in a bearish tone, you have relatively bearish internals, you've been coming down all morning, and it's the first test of the VWAP. The first test of the VWAP from the lows is almost always a short, and that's what's set up today. But where the main takeaway is what happened after that. When markets test the volume weighted average price in the futures market, especially on an intraday basis, you generally get a rejection almost every time. So you've got your VWAP coming like this. Imagine that price comes down, hits, and then it's like boom. It's a big rejection, and it's usually playable. You can do pretty well with just that line in the futures market if you've got the discipline to just play that over and over. It tends to work. Here's where things get interesting. On Friday, we actually went to the VWAP, but where's the rejection? Nowhere. You actually just came off a little bit, maybe just a couple points, retested it again, over, retested it again, and then did what? Spent about 15 minutes just sitting on the VWAP and not moving at all, right? Not moving at all, and then you start to lift around 3 p.m. up off the VWAP, and then this is the short covering move that ensues after that, where all of the people who are short just start throwing in the towel en masse. But really, the clue was already happening long before that in that, and this is the main takeaway that I want to give to you as far as this particular segment is concerned, is that think in terms of when what should happen doesn't. You have a bearish trending day on your hands. The market is trending down clearly from the open. It is bearish. You're starting in what we call the upper left down to lower right. In that particular scenario, if you haven't touched the VWAP even once all day, you should reject off of it. So all I'm saying is that the moment that this happened and you started just kind of going sideways and consolidating around the VWAP, that tells you that sellers were far less active, okay? And when we get into the next segment, I'm going to show you how you can actually use this volume weighted average price concept even on longer term charts as we talk more specifically about NVIDIA. Time now for our lead story, which is, should traders be buying NVIDIA? That is the big question on everybody's mind for a number of reasons. So I specifically wanted to break this down for you in this episode of the Weekend Edition because I know it's on the minds of a lot of traders since we recently had an earnings report. And in that earnings report, they announced that there would be a 10-for-1 split of the stock, which is effective on June 10th. Now, we're not going to get into the minutia of splits, but just so you understand, for newer traders, splits don't really change anything. What's going to happen on June 10th is NVIDIA is going to trade at 1/10 of the value that it is now, but there will also be 10 times as many shares out there in the float. So valuation does not change. Nothing really happens. The whole purpose of the split is to make the stock more marketable for a greater number of investors, because there are a lot of people who are a bit nervous about paying $1,000 per share, but they're a lot more comfortable at $100 a share. So that being said, let's get into the charts. And specifically because that split is going to happen on June 10th, we now have only one weekly options expiry, which is the one that will expire next week, the series of June 7th. We only have one options expiry left to sell very high in premium calls and puts, because obviously once the stock is cut down by a factor of 10, so will the value of its options as well. So there will not be as many opportunities for out of the money put selling, I don't think, at least, to get that rich premium that we've been seeing in NVIDIA the way it is now at over $1,000 a share. Now, in the last segment, I talked a lot about VWAP and anchored VWAP, if you recall, and that was on purpose to sort of set things up for where we're going to talk about NVIDIA right now. I've put this little blue line here as an anchored VWAP, and I purposely have anchored it down to this swing low. Basically, when you want to look at what the volume weighted average price is over a long period of time, you simply have to pick a swing high or swing low or some point on a daily chart that has some sort of reference to it. It could be, say, a high of a move. It could be a low of a move, as I was saying earlier. It could be right from the beginning when the stock IPOs, or it could be from an earnings date, etc. But it just matters that you pick something that is actually relevant. You can't just say, well, I want to anchor my VWAP from anywhere, somewhere here, like in the middle of the chart, because it doesn't really make any sense. So in this case, I'm starting from this low. That's the first thing I wanted to show you, is that because NVIDIA has advanced in price so much recently, climbing up into here around the 950 and then breaking out on the earnings, the actual volume weighted average price since the third week of April, when we bottomed out here, is about $929.57 currently. So right off the bat, that level is actionable, at least for the next week, while there's this rich premium in the puts, because you could be a put seller at the 930 level or lower. So keep that in mind. That's the first trade I'm going to give you, okay? The second thing I want to talk about is that there is obviously a clear breakout point here in the stock right up against this 950 area. You can see right here where there was this shelf, and I believe that is definitely going to be supportive coming in as the days progress, as we get closer and closer to the split. So that's another level that I'm looking at. And I like the fact that these two levels, being the volume weighted average price and this 975-ish area, that they're kind of tying together. Now, will the VWAP catch up over time? Absolutely, most definitely. As time moves along the x-axis, as we get deeper into next week, towards the end of the week, that anchored VWAP is actually going to move up a bit. If it gets up in here, right to the 975, it's obviously going to make that level even more powerful, because there's that confluence of multiple levels of the anchored VWAP and the technical level, right? So what should traders and investors be doing here? I believe that it's an option player's market, not necessarily a buy and hold market here at these levels, because the stock is still quite overextended. I'd like to see it come in at least to this level, closer to that anchored VWAP, closer to that breakout point, before I would take a longer term trade. However, that being said, I think there's plenty of opportunity to note that that support is there, especially with A VWAP, and be a put seller as we come closer into next week. So you can see this has kind of been our MO in weekly options advisory, and obviously here in my own trading for a little while now. You can see this is position in NVIDIA that just ended this week. This is just the kind of remnants of what I had left, but you can see I was long 1040 puts and short double the amount of 1020 puts. That worked out really well. And for next week, I've actually repeated the same trade, but notice where my strikes are right here, right? I'm long at 1,000 one time, and I'm short 2 times here at 975 and 970, and all of that is bringing in net credits, right? If you look at where the pricing is of what was sold, and they're relatively rich credits. You can see the average of about $1.50 for those mid strikes, and then buying those longer strikes above at $3.19. Those of you who are familiar with my MO, how I tend to approach the options market, you know that this is my favorite type of trade. I always like to be what I call net short, but in terms of collecting premium, I always want to have some sort of a long in front of my shorts because I feel that it's so much safer, and I also get to win both ways potentially, right? Like if we look at the NVDA chart and we get a move down to say 990 by the end of next week, let's just say the stock turns out to be bearish. Well, obviously being long the 1000 put is going to serve me very, very well, as those puts below the 975s and the 970s, they're going to go to zero, and my 1000s are going to have intrinsic value. And as I always like to point out to people, remember, is that if you are using this type of trade structure directionally, it can be extremely powerful in terms of the expansion of the spread in your favor, because you don't need to play it as if it was a binary event, right? Most people approach option spreads such as butterflies with a sort of binary thinking, meaning that it's either going to be such and such max gain or a max loss of zero. I never approach the options market that way. I teach all the people in my weekly options room day in and day out how to be net short spreads, and also how to set up spreads where more than likely they could easily just be buying something at zero and let that expand out to say 50 cents or $1 just by virtue of the way that the basic bell curve, you know, of how options premium is distributed, right? If you're looking at a situation like this, where all of the credit is here close to the money, correct? And we're talking about something on calls. Well, just think about it. If you start here as time goes along on the x-axis and you just do a +1, -2, you put your ratio like that, the stock doesn't really need to move in order for this to expand in value. This trade here could be put on for 0, but as time moves along the x-axis over here, it's probably, maybe it trades for $1 or whatever. Why? Because where's all the premium? The premium is crunching all close to the money. Your low strike here holds premium, and your short strikes go away, all right? So there's one way to play it for next week. This is all obviously going to change quite a bit once that split happens. So I'm purposely bringing you this trade, telling you where I think you should be short puts, telling you how I think the opportunities should play out for next week, because this is kind of the last chance, honestly. This is really the last gasp. It's not going to be as good once that stock trades at $100, $110, whatever. Once this gets cut down by a factor of 10, everything gets cut down by a factor of 10. So obviously, you can still affect these trades. I don't know what's going to happen to the implied volatility. I kind of think it's going to be lower. That will obviously bring the premium down on a more relative basis to price. But even if the premium stays the same, you're going to have to be doing, much bigger size in order to be capturing the same types of profits that you would be when the stock is expensive as it is now. Quick reminder, of course, if any of this is of interest to you, I trade these types of strategies live every single day in my weekly options room. And if you check out the link in the description, you can always take a $7 trial to trade with me live for 1 week for that low price of just $7. So very, very low risk. Again, the link is in the description below. Time now for Should I Do This Trade? This is the portion of the program where I take a question about options trading from somebody out there in the audience asking should they or should not do this particular trade. I give it a critique, and whoever question I choose receives a free month of the weekly options advisory. This week's email comes from Rhonda Eisen, who writes, "Dear Peter, I love your pre-market short video every morning. Totally what I need to get my head straight before the bell." Thank you so much, Rhonda. I appreciate that. She continues by saying, "I think semis are going to rally after this little pullback. I own a lot of them. What about this trade for credit collection on the put side in KLAC? Buying a broken wing butterfly using the June 7th expiry and she is choosing strikes of 725, 720, and 700, for which she wants to receive an 85-cent credit. Obviously, that structure of being long the 725s and short the 720s, but then covering all the way down at 700 instead of 715, that's what creates the credit. She goes on to say, I think KLAC will hold the top of the channel around that 720 area, so it seems like a good spot to collect credit against. What do you think? Let's take a look. Let's check out the charts. Move over to the KLAC daily chart and see what Rhonda has in mind here. Daily chart of KLAC. The top of the channel that she's talking about is this purple line here. I'm also kind of drawn to this congestion area here, right around that 710-ish level, going up to that 720 that she's talking about. I like that a lot. Remember, all instruments have a more difficult time chopping through areas where there's balance, where there's more of value, rather than areas that are like straight up or down on a chart. So that's a good starting point right there. I've also left that anchored VWAP on the chart from the same area as that NVIDIA, because it just so happens that that's also a pullback swing low in KLAC. Makes sense because they're both kind of in the same space. And notice that that anchored VWAP is coming in right at 716. So I have to say, I do like this trade as a credit collection idea. Essentially what she wants to do, as I was saying, she wants to buy a 725 call, sell 2 times 720 calls, and then buy the 700 calls, and receiving an 85-cent credit for the trade. Obviously, if prices stay well above the spread, the entire 85 cents is kept. Anywhere between 725 and 720 at expiry next week, June 7th, could be worth as much as $5, which is nice. The way I like to think about it is that if the price actually comes down close to that top strike, it doesn't need to go to 720. That spread should expand in her favor as you get closer and closer to Friday. But that will really only happen in the last couple of days of the series as we get closer and closer to June 7th. So overall, I must say I like this trade a lot. I think it's got a lot going for it. You have the anchored VWAP here supporting. You've got a prior high. You've got a decent sized reversal already going on Friday, which should be helpful. So overall, I would say, Rhonda, congrats. You get a free month of the Weekly Options Advisory. And not only that, I definitely bless this idea, and I think you should do this trade. And that's my show for this week. Thank you, as always, for spending a little bit of your weekend with me. Before I get into the closing comments, I just want to remind everybody of something that's been going on for a little while that we're pretty excited about. We've been getting great feedback on. That is Shadow Shorts. And I don't know if you're not getting them, you need to just sign up on our website right here. These are essentially short, 3 minutes or less videos, always actionable content from our entire team. If you recall, in recent shows, I talked about the new Live Trading Suite. We have 3 trading rooms actually at ShadowTrader.net. We've got my room, which is the weekly options room, but then we also have the stocks and options room and the futures trading room. And all of the traders that work at ShadowTrader, they all put together these videos every evening. You get one each evening. Like I said, very actionable, always something relevant and salient to what's happening in the market right then. Usually a trade idea or something very, very educational. If you want to get those videos every night for free, make sure you hit up our website right on the homepage here where it says free trade idea videos nightly. Just put your first name and email address right there, and we will certainly start sending you those every evening. All right. Now, as far as the market is concerned, keep it simple out there. I can't stress enough how it's really just all about that 821 EMA and the trend lines. In reality, you don't even need the 821 EMA. That's just a helper. Really, if you just go by the trend lines, that's all you need to do. And most importantly, remember that trend lines are not opinion. It's not nebulous, it's absolute. It's not opinion. A market cannot be in a downtrend anymore if you connect the highs from where the downtrend started and you get a daily bar closing above that line. The downtrend's over. That's all there is to it. It's not a guessing game. It's not my opinion versus your opinion. That is how it is. So for next week, what you want to pay attention to is, because we had that big reversal on Friday afternoon, if you start to see a daily bar closing above that downtrend, you simply have to switch your MO right back to selling puts and buying calls. It just makes sense. That's just the way you have to look at it, because that low that we just saw of this week's low, that low is now much more secure if we break that downtrend. So that's where my focus is going to be next week. All right. As always, if you can help out the channel, please hit the like and subscribe buttons before you leave this video. Coming at you from Los Angeles, California. As always, I wish you good trading and good night.